What if you could learn in weeks what it takes the average hedge fund analyst years to learn on the job? What if you could stop guessing at what your PM wants from you or how you should be spending your time and instead feel confident you are putting your efforts in the right direction? If you want to accelerate your buy side career, the Analyst Academy from Fundamental Edge will give you the tools, frameworks, and confidence to excel in any fundamental equity analyst seat in the industry. The Fundamental Edge Academy is taught by a veteran hedge fund analyst and PM, Brett Coffrin. Brett teaches a practical approach informed by his years of experience at some of the top funds in the world, such as Maverick Capital, D. Shaw, Citadel, and Schoenfield. Wonder how top long-term funds approach earnings season? That's covered. How will your PM expect you to add value in the first year on your job? That's covered too. Worried about what makes a good stock pitch? There's a whole module on idea generation and thesis communication. Plus, you'll get access to the Fundamental Edge alumni community, a highly engaged community which in just 1 year has grown to over 400 investment professionals. Fundamental Edge alumni get access to exclusive webinars, case studies, and an invite to their first annual Analyst Spring Training Conference in Arizona. If you want to fast track your buy side career, go to fundamentedge.com for more info. That's fundamentedge.com. All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, also the founder of yetanothervalueblog.com. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have Pedro Sousa. Pedro is a principal at Oxy Capital. Pedro, how's it going?
Hey, Andrew. Good to be here.
Hey, great to have you. I'm super excited to talk about the stock we're going to talk about today because it's one of my favorite sectors, a really interesting company, but we'll get there in a second. Before we do, just a quick reminder to everyone listening, nothing on this podcast is investing advice. That's always true, but for my domestic listeners, maybe particularly true today, we're going to be talking about an international stock. I always joke it's London listed, and I always joke that London might be an emerging market at this point, not a developed market, and people respond furiously. It's a little bit of a joke. But we're going to be talking about an international stock on the smaller side, so people should just keep that in mind. Please do your own research, not investing advice. Pedro, I was so thrilled you reached out to me about this idea a few months ago. I'm so thrilled to get on because it's one of my favorite sectors, a super interesting company. The company we're going to talk about today is Gym Group, and I'll just toss it over to you. What is Gym Group and why are they so interesting?
Yeah, thanks, Andrew. It's great to be here after hearing so many of your great podcasts as well. So hope I can bring something to the table as well as and contribute with an interesting episode. So Gym Group is a low-cost gym chain, as you mentioned, based in the UK. It's the number 2 there behind PureGym. They have 230 more or less gyms, which is about 30%, a bit less than PureGym. And they IPO'd back in 2015. They initially had a good performance and then hit a rough patch during COVID. And the new CEO entered last year. The company trades at 6 times EBITDA, 2024. It's a 260 million enterprise value, so significantly smaller than the other company that listeners will probably also know, which is Basic Fit. The reason it's interesting is twofold. And maybe before going into that, just to give some background, here at Oxy Capital, so we also do private investments, and the low-cost gym sector is one sector we've been invested in on the private side since 2014. So we think we know some of the more operational dynamics from an insider's perspective, and that gives us some. It's one of the building blocks for our thesis here. So in terms of why it's interesting, first of all, I think the markets, public markets, misprice this sector, okay? Because there's a number of dynamics you need to understand in order to price this correctly. One is the ramp up of the new gyms. So it takes 2-3 years for them to reach maturity, meaning to reach the normalized EBITDA per gym level. And so both Basic Fit as well as Gym Group, they opened a lot of gyms during COVID and in the year or two afterwards. And there's this hidden earnings potential of these gyms ramping up to full potential. And, as an outsider, it's difficult for you to believe in that because you've never seen it happening yourself. It's company management say a lot of things, and sometimes it's difficult to believe them 100%. We've seen this happen in our holdings in the private side as well. So we're comfortable underwriting this evolution. Then there's also the fact that the sector is working through normalization of energy costs, which were a really strong hit last year. And I think this is not entirely priced in at this point, at least in Gym Group. And then there's also some distrust by public investors, I think, of the sustainability of the ROIC of these concepts long term, and of the white space that is there still to be for growth in the next few years. And we are comfortable with this. Again, I mean, we are invested right now in a Spanish gym chain, and it's a large player in that market. So we know inside out the energy cost impact as well, and we're comfortable in writing that. And you can look at Planet Fitness in terms of the white space we think there is in the European market and the growth they've had over the last 30 years. And you can just compare gym penetration of different countries in Europe versus the US to gain confidence on the long-term potential for growth here. The ROIC sustainability issue, I mean, you had a podcast about Basic Fit that went into detail on that, but we can also go into detail here, but we're also comfortable with that. And then this is more the general side, and then specifically for Gym Group, I mean, we think it's a really interesting way to play this theme because it's cheaper than Basic Fit. First of all, so it's 6 times EBITDA to 24.7 times for Basic Fit. So you're kind of paying less for potential earnings, for potential growth in units going forward. There's this 6 times EBITDA. This EBITDA has more low-hanging fruit for management to actually increase it, even like for like. So in the existing gym states relative to a Basic Fit, because if you actually look at the mature gyms, they're actually still 30% below the pre-COVID EBITDA. Okay. If you assume that they were to close that gap and you apply that current states and already adjusting out for around 15 gyms that are really workforce dependent. So those are probably not going to recover. But if you just look at the other ones, if you do that adjustment, then the company will be trading 3 times EBITDA. If you do the same thing for Basic Fit, it's 5.5 times. So, again, greater margin of safety there. And we think there's still they have a similar or almost similar potential for growth going forward compared to Basic Fit. Just, of course, starting from a smaller base, so they need to open less clubs in order to grow at a similar pace relative to their current size, right? But the UK is still behind the US and the Nordics in terms of gym penetration, low cost penetration. In addition, there's a number of interesting near-term catalysts. So the new CEO, management turnover made it so that guidance was very conservative last year. They're likely to have a CMD, Capital Markets Day, this year. And I'm expecting them to, go to the market and be a bit less conservative, tell the story again, and help the sell side and investors get comfortable again with the potential for growth going forward and for 30% ROIC on new openings, which I think investors are not pricing in at this moment. And there's this potential to return to pre-COVID EBITDA, maybe less so through volume, which originally was the way they got there. But the gyms right now have less volume, less members, but maybe more so through yield, because they have a price gap versus PureGym that in our view is not justifiable, because customer reviews are very similar, even better for Gym Group gyms. And just closing that gap alone would bring them back to pre-COVID EBITDA per gym.
Well, Pedro, you did a great job. You hit all my questions I had, so we could end the podcast here if we wanted to, but I'll try to earn my bones as a podcast host here. Let me just start. You mentioned, I mean, look, the reason I was so excited to have you on is the Basic Fit podcast I did a few years, I guess it was like 18 months. I can't remember. Time flies so quickly. Was one of my favorite podcasts I had done. It's one of the companies I got most excited about. I've been following it pretty closely since. And, the stock's kind of gone nowhere since then. And I've been a little surprised that the thesis. So I was so excited because I've been excited about the sector and you've got the private background here. Let's just start with the first thing. You mentioned a little bit why this over Basic Fit, and it seemed to come down a lot to multiple. So I just want to start with that because I think it'll help us go into a few different directions. I hear you. This is trading cheaper than Basic Fit, but Basic Fit, I think people would say, hey, it's a larger player. They're in multiple markets, so you get kind of like the market diversification. And as the larger player, one of the things I said once that a lot of people have taken is like, look, if you're always buying the smaller, cheaper player, like do it once, it's okay. But if you're always doing it, you're probably not willing to pay anything for quality. And I think a lot of people, including some who I talked to prepping for this podcast, would say, hey, look, Basic Fit, you just get a larger, better run player. There's more leverage of the SG&A, more leverage of the tech, more leverage of the marketing. Like pay up a little bit because maybe it's cheap. Maybe Gym Group's cheaper 1 year out. But if you look like kind of 4 years out, Basic Fit actually might be better quality and cheaper. What would you kind of say to that?
Yeah, so I mean, Basic Fit is also interesting in our view. Okay, and in fact, we're also invested in Basic Fit with, although Gym Group is a larger position for us. I mean, in terms of being a smaller size company, I think you have to look at the size relative to the market. They are still very large in the UK, right? And that's what matters for their competitive position mostly. On the other hand, being smaller, you have less funds looking at the company. If you look at the shareholder registry of Basic Fit, it's a lot of American funds. So I think for me, it's more difficult to think that Basic Fit is conceptually, mispriced than Gym Group. Gym Group is mostly UK investor base, very, GAAP earnings focused, very dividend focused. That doesn't lend itself well to the low cost gym segments at its, growth stage, especially after such a disruptive event as COVID. And it's not just about multiples; it's about margin of safety. So you're paying a lower multiple on depressed earnings, while Basic Fit's earnings have already fully recovered to pre-COVID. And it's not just because of better management at Basic Fit. It's true that there was turnover in management at Gym Group, and that may have, made it more difficult for it to be managed and recover quickly. But there's now a strong team in place. But also, Gym Group, the one difference versus Basic Fit is that it's a no contract model, right? So members can come in and out whenever they want. Basic Fit does employ contracts in some of their memberships. And they did one thing that was smart, which was they froze membership fees during COVID. So people didn't have to cancel. So when things started to recover, membership recovered faster at Basic Fit than at Gym Group. So that's, I think, part of why there's this lag in recovery,
The no membership, the no contracts at a low cost gym just blows my mind just because I've used a lot of low cost gyms in my life. And the one knock on all of them is if you ever try, like you kind of have to, go to the post office and send a certified letter that arrives at, between the hours of 2 to 3 p.m. on a Friday, or else they'll reject you. So the no contract shocks me. Let me just ask one more question on comparison here. I think the other thing people would say is...
Sorry. Maybe just before that, just one other thing, which is, if you look pre-COVID, Gym Group had more members per square meter than Basic Fit, a lot more. So I think it's also a more higher volume, even lower price model historically than Basic Fit. So that's also, I think, why it had a bit more difficulty adapting to the newer reality where there's less members. Maybe they work out more, so they're more willing to pay. So it's a period of adjustment. But I think you can look at the Basic Fit markets, at the US markets, the Planet, and their corporate-owned stores, to see a bit where the industry is going to be in the UK in a year or two from now. And you just have a much greater margin of safety because, in a scenario of the world where we are wrong and low-cost gym economics actually deteriorate, you're probably not going to lose money in Gym Group because, you already have this margin of safety. In a scenario of the world where we are right, you're going to make money in both cases, in both Basic Fit and Gym Group.
Just not on Basic Fit in particular, but I think the one other thing people might say choosing Basic Fit and over Gym Group is, hey, Basic Fit is the leader in most of their markets that matter these days, right? They have the most. And I think people really like this kind of entrenching this entrenching model, right? Where you build 3 stores in one small market. And then because you've got 3 stores and they kind of overlap with each other, you crowd out every other, you crowd out every other possible entrant. And this is, Domino's Pizza talks about doing this. Basic Fit's talked about doing this. I guess with Gym Group, my understanding, and tell me if I'm wrong, because PureGym is private, so it's tougher to get information. I think PureGym is larger than them. And obviously Planet Fitness is larger than all of them, but Planet Fitness is US. So size doesn't purely matter, but Pure and Gym Group are both similar markets, and they're both UK focused. So I think Pure Group is larger. And I guess I just wanted to ask, buying the number 2 player in the low cost fitness space, like how do you think about those dynamics? And if I said anything wrong, please feel free to correct me.
Yeah, no, it's true. So PureGym is larger. We actually also invested in PureGym a year and a half ago, I think, because they have publicly traded bonds.
Yep.
Back when they were at the 15% yield to maturity, now it's more normalized. But last time I remember, so they had around 500 gyms, but part of that is in the Nordics. Okay, so in the UK it's around 300 gyms, and Gym Group is at 230. So it's not a major size difference. It's more of an oligopolistic market compared to the to Planet in the US or the Netherlands for Basic Fit. But we think it's a rational oligopoly. We spoke with former employees of Gym Group, current people at PureGym, and at the other meaningful competitor, which is JD. The takeaway really is that both the quality of the gyms, the member satisfaction, the quality of the operations surrounding the gyms seem very similar to us, especially between Pure and Gym Group. If you actually, you can map out the gyms and the locations on Google Maps. We did that, and you go look at the reviews. There's actually more underperforming gyms at PureGym, a longer tail of gyms with 3 stars, 3.5 stars. And if you compare, for example, cost per gym, it's actually lower at Gym Group than PureGym. The problem is that the price is much lower at Gym Group than PureGym, and historically they made up for that with higher volume. But given the quality of their operation seems similar to PureGym, we think they can close that gap and get back to a higher EBITDA. So we think you're not too disadvantaged by being the number 2 in these markets.
Brett Coffrin, founder and lead trainer of Fundamental Edge, barely remembers his first year as a hedge fund analyst. Most of the year was spent in a blind panic. Was his research any good? Was he learning fast enough? What did his PM really want from him? Trading on the buy side was non-existent 15 years ago when Brett was a new analyst at Maverick Capital, and he actually got demoted. Then he worked harder, found mentors, and asked for uncomfortable feedback. Eventually, he turned it around, learning by osmosis from the talented people around him, and rose to managing director. But is this the best way to develop talent? Brett doesn't think so, and that's why he founded Fundamental Edge. The Fundamental Edge Analyst Academy provides students with the tools, frameworks, and confidence to excel in any fundamental equity analyst seat in the industry. Lose the panic and fast track your career on the buy side. Find out more about their next cohort at fundamentedge.com. So just speaking of raising price, right? Like one thing they've consistently said, and there's a slide, I'm trying to remember it properly in my head. There's a slide that shows them versus their top 3 competitors and shows that they're consistently under them. And even though they're raising prices, like they haven't really fully closed that gap because their competitors are raising prices, which is great, right? Yeah. Like one of the nice things about a low cost, but if you're the lowest cost player, you've got a little bit more room to catch up to your. They did say something interesting on their earnings call, though, right? On their last earnings call, and this was their earnings call from H1 23. So the new CEO, who we'll talk about, had just joined. They said, hey, we've had some of our competitors who are moving out of the low cost space and moving into the mid-market space, right? So they're kind of transferring, scaling, enhancing the value a little bit, going up price point. That's really interesting because I could read that 2 ways, right? I could read that as, hey, all these guys are taking price, and what's happening is in the post-COVID world, with all the work from home, the space has completely changed, and people are realizing, hey, the low-cost model doesn't work anymore, so we kind of need to flip it around. Or I could read it as, hey, all these competitors, you've got maybe players 1, 2, and 3 are profitable, but players 4 through 10 are looking and saying, hey, we can't compete with the big guys. They've got more spaces, better leverage of their SG and everything. We need to do something different, so we need to go mid-market. So I guess to you, which is it when I read that quote to you, some competitors moving from low cost to mid-market?
Yeah, I think it's a mix of, in general, the industry is increasing prices. In the US, Planet Fitness is trialing $15 subscription, $12 subscription. which is a sizable increase from their $10 currently. Basic Fit, you can look at their ARPU. It's also been growing a lot. PureGym as well. They have some public reports because of the bonds that are traded. Everyone is increasing prices. So it's normal to expect the industry to increase prices. And I think management was also a bit saying that, given such a high increase, some of these gyms are actually now going into what was previously considered mid-market. With that said, if you look at the industry reports that are around, it's true that what they say is that in 2023, the number of low-cost gyms was relatively flat in the UK. In fact, I think even declined a bit, although the larger players obviously grew, like PureGym and Gym Group. So it's possible that I don't have specific data on any specific chain trying to adapt their offering, but certainly the ones below JD, which is number 3 and has close to 100 gyms, the ones below that level, they're going to be much less competitive. And if Gym Group is still struggling a bit, you can imagine that those guys are going to be much worse, right? So you probably have to adapt their business model.
Let me switch to another question. So I mentioned, I've been loosely following Basic Fit for 2 years now, right? And I have been surprised both at Basic Fit and especially Gym Group when I was looking at them I thought the inflection would be here by now. And on Gym Group in particular, and I'm just looking, they have not reported the full year 2023 numbers, right? They did give the trading update where they said revenue and leverage, but they haven't reported like the full hog. But let's just use their H1 23 numbers, right? Revenue was 204 million pounds. Adjusted EBITDA less normalized rent was 17 million. It's about an 8% margin for H1 23. And that's down from, I have it at 20, am I reading this right? 20% in H1 22. Is that correct? My numbers look a little funky, but margins it has to be down a little bit. I'm not sure if it was 20%, but it has to be down because even in their trading update, they said, hey, our revenue growth has been offset by cost inflation, right? And I guess I'm just surprised by that because, I would have thought 2023, particularly like COVID's in the rearview mirror. Everybody's going back. They've had 3 years at this point to refill the gym. I would have thought we would see some of this kind of margin inflection story, the refill story. And I understand that, especially in the UK, there have been issues with utilities and energy costs, but I just don't think, and when I dig into their numbers, it doesn't seem to me like the utility and energy costs completely explain why the margins aren't inflecting up. So kind of why aren't we seeing this inflection happening?
Yeah, so just on the numbers, so I have them at 37 million EBITDA for 2023. It's in line with consensus. And that would be an 18% margin EBITDA at the EBITDA level, pre-IFRS 16, so after rent. And in 2019,
yes, that's right. I think I was using a H1 EBITDA number, but still margins did degrade from 22 to 23, I think is my overall point. And I would have just overall expected them to have expanded over that time period, even ignoring the utilities just because of this refill, the gyms maturing. It's not like they opened a ton of gyms in 2023. They are going to accelerate in 2024, but I would have expected some margin expansion, and it's not playing out. H1 19 back in 2019, I think they were doing low 30s margins, and now they're in the high teens. It just feels like they continue to go kind of backwards. I don't know if that's too. I'm rambling here, but I just wanted to ask what's going on there.
Yeah. So the energy cost increase was close to 10 million impact in 2023. So if the margins would be up adjusting for that, because EBITDA margin in 2022 was 22%.
Yep.
38 million, right? And 18% in 2023. If I just add 10 million on top of the 37 million, that would give you 47 million EBITDA, which would be 23% EBITDA margin. Yeah, versus 22 for 2022.
Yeah, so that's slight expansion, but even with that, you would have thought, just because early 2022 was kind of the last of the COVID restrictions and they're getting lifted, you've had 2023 was a clean year. I just would have thought you'd see more margin expansion here.
Yeah, that's true. They've had a lot of inflation in general, right? In the other costs as well. There was a minimum salary increase, minimum wage increase last year as well in the UK, and in general, it's true. Also, the gyms that are ramping up are not just last year's gyms, but also the ones from 2022. I think that with COVID and the after COVID effects of less people going to the gyms for a while, in general, the time for a ramp up of the gyms got longer. Okay, because it takes longer for a new gym to acquire members to reach that run rate level. So I think that's also a factor.
Perfect. So one of your angles, which I thought was really interesting on the bull side, is you said, hey, there's this famous thing where Exxon CEO comes out in the 80s or something. He says the cheapest place you can drill for the oil is on the New York Stock Exchange, right? And I think what he was kind of saying is at the time we could go drill new wells and our all-in cost for oil would be 25, but if we buy back stock, it would be, we're buying our implied oil reserves, which are probably better than the oil reserves we're going to go drill for. We're buying them at 20 or 18, so a big discount. You had an interesting thing in your write-up that said, hey, when we buy Gym, like forget this forget the earning stream, forget like the advantages we have. We also think we're buying it for below the replacement costs of their gyms. Do you just kind of want to walk through that math?
Yeah, so that was when the share price was a bit lower. So now I'm not sure if it's exactly below replacement costs, but they have 230 gyms, round about that. It's a bit more, and the cost to open a new gym would be 1.4 million. So just multiply that, get you to 320 million, and the current EV is 260 million. Yeah, that's a bit the rough math. If you factor in depreciation, not at their actual depreciation rate, because useful life is shorter than reality, because they are depreciating some of the building improvements that last a very long time, then they are trading slightly above depreciated costs, but not too much above. And that's quite interesting if you think that they can get back to a 30% ROIC on that base, even if you exclude the workforce dependent gyms, which are only 15 gyms, okay, that they've identified, that are really in the city centers. Even if you exclude that, it would probably still be trading below replacement cost. And we think they can, again, just closing that price gap versus PureGym would get them back to 30% ROIC. And maybe just one thing on that as well. Even with the current EBITDA base and gym base below the 30% ROIC, which is the case, they disclosed in H1 20%. Even then, we think they are opening new gyms at 30% ROIC. Because the 20% on the existing base is driven by the fact that those historical locations were disrupted with changing consumer patterns post-COVID. And of course, also, energy cost inflation, etc. But we see from our private investments and from speaking with management as well at Gym Group that you can adapt your locations to open new locations still at the 3-year payback, 30% ROIC. And we think the market is not pricing that in either. So just an aside on the ROIC.
No, that's great. I like that. I just back to the replacement cost. Like one of the things I do love, I love buying assets with a subscription business where you're buying it kind of at or below replacement cost of the asset, because you're getting the in-place subscription business for free. And like, as you know, going and getting what I think each gym is between 35 to 4,000 members at Gym Group right now. I could be misremembering if that's it might be slightly lower. I'm pretty sure I'm in the right ballpark though. But it takes time, it takes money to go acquire all those 3,800 members at the gym. So when you buy the asset base for the asset value, you're buying that subscriber base for free. Now, obviously there's lots of other stuff going on, but I've always like something about that. Buy the asset. Cable companies, when you sometimes you'll go find a cable company, and a cable company would probably take $1,500 per home pass to go like recreate the assets. And when you can buy it for $1,000 per home pass, and that ignores that they've already got, 30% of the homes already connected, paying them monthly, which would take 3 years and X tons of money for someone to go replace that. Something about that just always has really struck me as attractive. Let's go to.
Yeah, I agree. Maybe just to follow up on that, that increases the margin of safety, right? Because if you're buying,
Yes.
if you're buying cheap on earnings, basically what you're saying is that you're buying at a low ROIC, because, right? So if you're buying at a low ROIC, that means that there's not going to be new players opening new gyms, right? Because of low ROIC. But you're still buying, it doesn't matter to you what is the ROIC of the existing base, because what matters to you is the price you're paying for those earnings. So they're actually more protected by the fact that you have a lower ROIC on the current estate. Not to say we don't think they can get back to those higher ROICs, but just to say that the fact that the existing base has a lower ROIC now than before is not necessarily a bad thing, as long as you think that on the new capital that they deploy, they can get good ROICs, which we think they can.
A cheap enough price can make up for a lot of bills, right? Like I personally wouldn't want to get into, I don't know, what's the worst business you can think of right now? I can't think of. I would normally say coal, but coal prices are off the charts, so coal's not a bad. Let's say coal. I personally wouldn't want to, but if you could buy all the coal mines in the world for $1, like that's pretty interesting optionality. Let me ask 2 more questions that just jumped out at me. Right, I'll start with the earlier one. In October of 2022. The company did a massive discounting of their membership to try to fill up. And they've said they're not going to do that again. They had a lot of learnings. They learned a lot. And I like that they've learned from it. But at the same time, when I hear a low cost gym discounting to fill up, especially, it's not like it was October 2020, it was October 2022. I just look at that. And again, I just say, hey, is there something I'm missing here? What happened with that huge discounting wave in October 2022?
Yeah, so we don't know the inside of that story, of course, but I think it comes back to post-COVID. I think the key for them is to focus a bit less on volume and more on yields, right? Historically, they had a lot of members per square meter, more than PureGym and Basic Fit. And that's how they succeeded with such a low price. It's far below Basic Fit, especially if you consider it's in pounds versus Basic Fit in euros. And post-COVID, I think there's some people that didn't come back to the gyms. The ones that did come back, they go there more often. So there's a bit more of a higher willingness to pay. So I think you should probably charge a bit more. And that's what you're seeing with Basic Fit increasing the penetration of their premium offering. They are at the Gym Group at an earlier stage of that progress. I think they've realized that that's the way to go, more than just go for volume and nothing else. And the new CEO is also well suited for that. He's not from the industry, but he's got a lot of experience in subscription businesses and in optimizing these dynamics around, the price you charge, volume, and that's where he's focused. And so I think it's going to play out well.
So you actually hit there the final 2 things I really wanted to drill into. So let's start with, I think the more important one, and then the new CEO, right? Because the other thing I see here is hey, the discounting in 2022 kind of, in my opinion, the ramp up not quite happening as well as you would hope post-COVID. And they changed CEOs over the summer of 2023. New CEO joins like right before the H1 23 earnings call. So he talks a little bit on it, but you don't get tons of info because he's very new, right? But as you said, he is not from the fitness world. He is from the, as he says on the call, the subscription and membership world. So you can see the company is really focused on, hey, we need somebody who knows how to manage churn, growing memberships, not somebody who, can bench 500 pounds or something. But I just want to ask you, I'm sure you've talked to him. What's your thought on the CEO and the CEO change? Because again, CEOs don't change lightly. So the fact that they change CEOs shows there was something they thought they needed to improve or work on. What's your thought on him?
Yeah, so I spoke with him once so far, and I'm waiting for the results. I'm probably going to speak with him again afterwards. I've had a good experience. I have a good view on him. I spoke with people that worked with him at prior companies, and
where did he work prior? Do you just want to let listeners know?
Yeah, so he was at Times Media for 3 years. Which is the company for that operates the Times and Sunday Times to newspapers in the UK. So they have those subscription dynamics, same as a gym, and he was also at British Gas, so also has a bit that subscription dynamic for 8 years. So not the same kind of business, but it has similar dynamics in terms of the subscription side. And the people I spoke with, they had very good things to say about him in terms of overall his reputation. But we still have to see what he's going to do. Now, the information that I have is also that the prior CEO, Richard, which I also met, some of the shareholders and the board thought, the company needed someone with more ambition. That's the information I have. Okay, and they decided to conduct the process and ended up with Will. In practice, I think it's also because Richard, he presented this plan for the company to reach 100 million EBITDA in, I think, 2025, back at 2022 CMD. And because of the energy cost increase in 2023 and just a bit longer term, a bit longer that the recovery to pre-COVID is taking, this is going to be quite difficult. So I think this kind of deteriorated a bit in starting at the company and made it a bit natural to search for a replacement.
Cool.
I don't think there's any cockroaches in the kitchen, let's say. So we spoke with a lot of people, including senior former employees, and nothing like that came up. So that's not the response to the thing about the discount that didn't go well. So we think there's nothing very bad behind the curtain.
I don't think there were. No, completely agree. I agree with everything you said. No need to add anything. Let's talk. They're working on the 3-tier pricing membership, and you did start talking about it a little bit, but I just want to drill into it a little bit. The 3-tier pricing membership. What is it? And you have seen, and I'll kind of lead the witness here. You have seen other gym groups. You mentioned Planet Fitness earlier. Basic Fit's played around with it. Other gym groups have started exploring, obviously, the 2-tier, but also the 3-tier membership. So, what is the 3-tier membership gym groups going for, and how do you think that kind of affects the economics going forward?
Yeah, so it's just basically a way to price discriminate more the members, right? So the more tiers you have, just basic microeconomics, the easier it is to charge the full willingness to pay of each customer. Because maybe some are willing to pay a bit more in order to have some better amenities, or just to have more flexibility in the times that they go to the gym. The 3rd tier they are introducing is, I believe, it's an off-peak membership at a lower price, and that makes sense because, especially after COVID, the people that do go to the gym are going more. So with less membership in a specific gym, you have greater attendance. So there's a need to kind of sort that out, and price discriminating that through an off-peak option is a good idea.
They gave the example, look, the gym, when is it most crowded? Generally, gyms are most crowded 7 to 8 a.m. in the morning or 5 to 6 p.m. at night, right? So right before people kind of leave to go to work or right after. And you could imagine with work from home and everything, you could offer, hey, Pedro, you work from home every day. You go to the gym at lunch. Our gym is empty at lunch. You never go at 5 to 6 o'clock. If you will forgo 5 to 6 o'clock or 7 to 8 o'clock membership, we'll charge you $70 instead of $100. That's great for you. You might take that up. And then you charge me and say, hey, Andrew, you go to the gym before you head to the office every day, 7 to 8 a.m. You've got to pay $100 to go at peak. That smooths out demand. It smooths out, it makes, for me, it's more valuable because you know what I hate? Waiting 30 minutes for my squat rack when I've only got an hour at the gym. So it kind of decreases the peak demand. It smooths out. It makes tons and tons of sense to me. Sorry, I cut you off. Please continue.
No, yeah, that's exactly it. I mean, I'm also a fellow gym goer as well, so I can confirm it's quite annoying to have to wait. And that happens more frequently nowadays because the people again that are going. So even though the membership level is below pre-COVID, attendance is actually closer to pre-COVID and up versus pre-COVID in many sites. And that just speaks to the opportunity to optimize yields, right? Because maybe less people going, but the ones that go there go more often, so they value that more. And again, just also on the premium side as well of things. So they also have a premium tier where you have access to all the clubs and you pay more for that, £5 to £7 more, which is around 30% increase to the base price. And we think there's also a good opportunity there because they're 30% penetrated. So 30% of the membership base uses that. Basic Fit is targeting 50% in 2024. So again, you can look at these other markets and extrapolate a bit with the 1 year lag, I think, to the UK. And it bodes well to the gym economics at Gym Group.
Let me ask kind of what we're playing for, right? So let's say right now, 230 clubs. Let's say by 2025, we're up to 250 clubs, which I think is kind of reasonable, right? They said they're going to do 10 in 2024, 10 in 2025 sounds reasonable. So let's say 250 clubs. Walk me through kind of what normalized earnings level you think we could hit in 2025, or you can run it out a few more years if you think normalization takes a little bit longer. But let's just walk through what normalized earnings level looks for these guys.
Yeah. So I think they should be able to open more than 10 gyms a year. At the 2022 CMD, they were actually targeting 25 to 30 a year. Now, of course, new CEO, all the problems in 2023 with the energy increase, the cost increase, and they contracted that number, at least for 23 and for 24. And they haven't said what they're going to do in 2025. But one, in terms of white space, there is white space. So the UK is 16% members go to the gym, US is 20%. There's 50% of the gyms are low cost in the UK, up to 70% in the Netherlands, for example. So there's space for them to open more gyms. And they can do that with their earnings. So they should be at, call it 45 million EBITDA in 2024. That's my number. It's a bit above consensus. And cash conversion pre-new openings is probably 50%. So they're gonna have 20 to 30 million after maintenance capex to deploy in new gyms. That allows for 20 to 25 new gyms a year. So, I mean, I think they could open 20 a year for a couple of years, let's say for 5 years, right? That would be 100 gyms. That would get to 330 gyms. You can take out the workforce dependent gyms, which are 15. That gets you to 315 gyms. And now here it depends on whether or not you believe that they go back to 2019 levels. I mean, we call it 5 years to increase ARPU to get there. We think it's and to close that gap to PureGym. We think that's quite feasible. And that would mean doing about £430,000 EBITDA per gym. And that doesn't even account for inflation, right? So capex has increased since 2019, capex per gym. So actually believing that they're going in 5 years to reach this 400 and something thousand EBITDA per gym, is still a ROIC below pre-COVID. So
if I can just pause you, it's funny you said that number because that's exactly the number I have for my per gym EBITDA. I don't think it's crazy. Like there's lots of, I look at basic fit. I've looked at all these. You look at the pre-note, but I guess, for people who are listening at home, if you just kind of said, look, right now, they're doing 19 pounds per month in ARPU, and they've got what is it? Let me just do this one. 19 pounds per month in ARPU, and they've got about 3,750 members per gym. That means each gym is doing about 850,000 pounds in revenue per month.
Yeah,
so
yeah.
you already know what the revenue is. You kind of said 870 there, I think, or 850. You know the revenue, and now it's just trying to figure out club level EBITDA margins. And I think most people think 50% club level EBITDA margins are about right. So that gets you to the 435-ish thousand, 450, whatever the number is, but that gets you around there. So I was just laughing because I have basically the same number, and I just wanted to reinforce that. So that's the club level EBITDA number. Let's just walk through the rest of the income statement, right? We've got club level. Obviously, there's SG&A. We can talk MCX, but let's go through. And I've got my numbers that I'll intersperse as you go through them as well.
Yeah. And just one point on the EBITDA per gym. So right now they're at 320. Right? At least that's my estimate for 2024. 2023, it's 10K less. And to get from there to the 430, if they close the price gap, that gets them above that level already, right? Because 12% price increase, which is gap versus PureGym, on such a model with high operating leverage, that gets them more than 100K per gym in additional EBITDA. So then, just multiply that by the number of gyms, gets you to 135 million EBITDA pre-HQ. Right now, they're at 20 million HQ costs. In 5 years, let's say 25 million. That gets you to 110 million EBITDA. And current TV is 260 million. And they could do these openings with their internal cash flow. And obviously, that's 2.5 times a multiple of EBITDA 5 years out. So we think that's quite attractive. Right now, they trade at 6 times EBITDA, but they start with trading at 10 times. And if they do this in 5 years from now, they're not going to be trading at 6 times because the market is going to be again pricing in this potential for growth because the sell side investors would have regained confidence in the 30% ROIC on the openings. This is a bit the investment case. I guess we can also walk through the bridge from EBITDA to cash flow. Of course, we underwrite based on free cash flow, but it's easier to communicate through EBITDA.
I don't want to harp too much on the bridge. Maybe we should, because I got some questions that were like, hey, why does this company never produce cash flow? And I get that on basic fit. I actually think here it's much less of a concern because look, yes, they are opening new gyms and you can break that in, but they're generating cash flow from operations. You can make assumptions around maintenance CapEx. They've said 5 to 6% of sales are kind of maintenance CapEx. That feels maybe a touch low to me, but directionally correct. So, I don't think there's any huge issues with they're investing new gyms. If the returns aren't there, they can stop investing new gyms. If you believe the returns are there, obviously you do, obviously they do. It's going to be a good investment in the long run. So I'm a little surprised by that, but I'll let you comment if I missed anything there. If there's any, they're not really that levered. So I don't think there's crazy interest expenses to deduct, no crazy tax situation, but I'll go ahead, please.
Yeah, so I agree. I mean, 2023, you'll see that they look at the first half, they generate a lot of free cash flow because they kind of stop the openings a bit and confident that's going to be the same for the full year. And if you go back and you add back the new opening capex, you get to healthy free cash flow levels. And in terms of the maintenance capex, I think this is a fair point around the industry in general as well, because especially in Europe, most of these chains were started not too long ago, right? 10, 20 years ago. So you can look at Planet Fitness again. That's a longer running concept. And the franchisees seem to be okay with the levels of maintenance capex that they have to do. It's been around for I think 30 years. We looked at each historical vintage of openings at Gym Group, at when will they need to replace the cardio equipment, the strength equipment, etc., at what prices. And if you do that bottom up, we got relatively comfortable with the management target of 6% of revenue. Maybe, in some years there could be some lumpiness, could be higher than that, but on average it shouldn't be too different from that. And that is not factoring in something that also helps them, which is that in general there's a trend towards less cardio at the gyms, and you'll know this if you also go to the gym frequently, and more strength equipment, functional equipment, which is much cheaper and lasts longer than treadmills, let's say. And then there's also yeah.
As a lifter, I mean, I was until I've told everyone I tore my pec bench pressing. But, as a lifter, every time I read one of these things and they're like, hey, treadmills are still important, but we're taking out, they said it on one of the things. They're like, we refitted 13 gyms to take out some treadmills and put in some extra squat racks. I'm like, yes, let's go. We're winning the war here. That might be too personal, but quick question. Oh, please go ahead.
No, I think that's mostly it. And just one last point, which is you should also see what Basic Fit did with Matrix. They announced at their CMD that they did a contract with them so that instead of substituting the equipment after 6 years, they substitute after 12. And at the 6-year mark, they just do a refurb. That lowered them the maintenance capex a lot. I mean, Gym Group is also a substantial client of Matrix. So maybe they don't get as good terms as that, but that also gives me confidence that in general you can manage through that.
Just quickly, so let's say people listen to you and they believe, all right, hey, the 4 to 5 year out, 300 clubs, maybe more, 330, whatever they want to use, generates, I think on my numbers, that generates about 100 million in EBITDA, right? 100 million in EBITDA. This is a 263 million EV company. So that's a lot of EBITDA for that. But what type of multiple should people be thinking about there, right? Because I think people will have two things in their mind. Planet Fitness, which is pure franchise, trades for roughly 1,000 times EBITDA. Or, a lot of people might think a gym, your typical gym, a one membership gym, lots of MCX, the EBITDA here, there is a MCX component, as we just talked about, lots of hard costs, that type of stuff. A solo gym is not going to trade for a big EBITDA multiple. This is somewhere in between. I just gave you a 2x EBITDA to 1,000x EBITDA. It's somewhere in between there, right? What EBITDA multiple should people be thinking about this trades for 4 years out, 5 years out, if the numbers that you talked about are correct?
Yeah. Can I just mention one last thing on the free cash flow before that? Of course. Yeah. So just for our listeners to understand, so if you have 430,000 EBITDA per gym, just to understand a bit the bridge. So then you probably have around 60 to 70k of maintenance capex. And then taxes.
Yep.
So that's around 60% cash conversion at the gym level. In fact, there's also negative working capital, so it's a bit higher than that. So the 30% ROIC that they state, it also bothers me a bit that the whole industry uses EBITDA as the ROIC measure, not free cash flow, right? But it still translates into a 20% more or less cash IRR. And at the Gym Group level overall, with the HQ costs on top of that, we think it should be around 50% cash conversion. So these EBITDA multiples are attractive considering that, because the implied free cash flow yield is quite high. And that gets me also to the exit multiple that you were mentioning. So if you consider in a couple of years from now, maybe these companies are going to be mature, less white space. It's going to be more of a cash flow story, I think. I think it's still going to be defensive because it's still going to be low cost, so resilient in a recession. We saw trading down happening in 2008 and also in our own private holdings in 2014 here in Portugal, because it was a tough time economically. So there's a bit of a breach. There should be a bit of a premium on the cost of capital for that. And it's going to be more of a cash flow story. So you can imagine earnings at that point growing 5% a year, maybe a bit over inflation with a couple of openings a year. If you think the right cost of capital is, say, 12%, it could be higher, could be lower, let's say 12%, then the implied free cash flow yield for a fair price would be 7%, right? 12 minus 5. Which is a 14 times free cash flow multiple, 7 times EV/EBIT. So I think between 6 and 8 times is reasonable when these concepts get mature. And with that said, for example, with the case of Gym Group, I think they could be able to double the number of gyms given the current white space, just because there's probably 30% upside on the population in the UK that goes to a gym, because it's 16% versus 20 in the US. There's probably another 30% upside in terms of higher market share of low costs within the overall gyms, or maybe more like close to 50% if you compare with the Nordics and the Netherlands, which are more mature in terms of low cost concepts. So the market as a whole could almost double. And then you should consider that the largest operators usually take the most share of new openings. Gym Group could probably more than double the size of their current gym base. And at 25 clubs a year, they will not do that in 5 years. So in 5 years, I think there's still going to be space for them to continue to grow. So maybe they should actually trade at a higher multiple than this 6 to 8. Not that we need that to do well here. In fact, I mean, if they don't open any gyms, but they're just able to close that EBITDA gap to pre-COVID, you already wouldn't do too badly, because you're already paying like three something times EBITDA for that.
Yeah, I mean, the nice thing here is, again, price protects a lot of downside, and the 2023 results, which, as we talked about, are hopefully the bottom for a lot of different reasons. The utility reasons we talked about, new gyms that are still ramping up, still a little bit of fill in from COVID. There's still some pricing power speed, all this sort of stuff. Like, if you just took 6x on the 2023 numbers, 6x EBITDA, you'd get a little bit of upside from today's share price. And again, for all the reasons we talked about, you'd hope there's upside. Last question, and then I'll turn it over to you for last thoughts, and then we'll wrap it up. Look, I think I said at the beginning, the Basic Fit story, when I first heard it a few years ago, I was so interested in it. I followed it pretty closely since, and it just hasn't worked. I guess just on this one, what kills it, right? Because for the past couple of years, it feels like it hasn't inflected. And when I was hearing people responding, I think a lot of people, I was very curious by the free cash comes, but I think a lot of people were just like, this isn't going to work. Something's going to go wrong. What kills this in your mind? Like, how does this fall apart? Ignoring COVID, I guess it would be like 8.0 at this point, like shutting everyone going down from the gym. We can put pandemics that keep people. What kills this particular story short of pandemic?
Yeah, so first, just on the fact that it hasn't worked yet, I think the energy thing in 2023 was a major factor, because otherwise EBITDA would have grown by 10 million in 2023, and probably stock would be up from a year quite a lot already.
So if energy prices in Europe, and they are coming down a little bit, right? They were absolute peak. If energy prices just completely normalized, is that a 12 million tailwind to Gym Group at this point, or have they kind of hedged out the cost so much that they actually wouldn't see much benefit?
They hedged out until I think mid 2025, if I recall correctly.
Okay.
And the price that they've hedged out implies a 2 million benefit in 2024 relative to 2023. Okay. With that said, you cannot analyze the first half of 2023, because there's already going to be a bit of a decline in energy costs in the second half. But in terms of the energy costs, we think they can still do more. So if you look at Basic Fit, they were able to reduce energy costs more relative to peak impact. And they are targeting to continue to reduce like-for-like consumption at their gyms, Gym Group.
Like all the best investors, Fundamental Edge believes that the learning process never truly ends. That's why the Analyst Academy is just the beginning of their journey with you. Fundamental Edge alumni gain access to exclusive content, such as their guest speaker series. It recently featured TED CDs of capital allocators. Alumni can also look forward to frequent webinars, case studies, and content from industry partners. For job seekers, there's the Talent Hub, which helps both Academy graduates and other buy-side candidates connect with top funds looking to add new analysts. Alumni, including students enrolled in the upcoming January cohort, are also invited to the inaugural Analyst Spring Training Conference coming up this spring in Scottsdale, Arizona. Attendees will engage in numerous learning sessions while building their buy-side networks, and then they'll enjoy some spring league baseball and the amazing Arizona weather. If you'd like access to all that Fundamental Edge has to offer your career, visit fundamentedge.com for more information about the next Academy cohort. That's fundamentedge.com. Perfect. Okay. Sorry, but just ignoring energy, I guess I did want to make sure I asked, like, what kills this idea to you?
Yeah. I think the key thing is really two things. One, the recovery of the EBITDA of the mature gyms or of the current gym base, right? So for that, we need to believe that they can increase prices above inflation or get back the volumes that they lost. I am comfortable with that because I see other operators increasing prices. It's obvious that gym fees have to go up because of the inflation you've seen everywhere. If you look historically, you would think that because it's a low cost concept, they would have had difficulty increasing prices, but they've actually kept up with inflation since 2012 until 2019, increasing ARPU 2% a year. And since 2019, they've been executing so far. I think they've increased 5% a year ARPU since 2019 until 2023. And you see other operators doing the same. The other thing that could kill it is that not kill it because you're not paying for it, but at least take out some of the upside is the white space and their ability to deploy at a 30% ROIC. If you ask management, they think they can get 30% on new openings. We also see that on our private holdings, okay, that some of the existing gyms may have been impacted, but
I do hear you on that, but that doesn't kill the idea, right? Like, as we discussed, it's cheap enough now that even if they don't get the white space, like, yeah, it would suck. If this grows to 500 units at 25, 30, 35% ROIC, this is gangbusters, but it doesn't kill it because you still have the existing base. And that's what I like so much about it. But the one thing I struggle with them is I look at these and Basic Fit as well. And I'm just like, hey, how do I lose? And I've had one friend who I talked to about it. I was like, I don't understand why this hasn't worked. Like, how do I lose? And he's like, dude, look at the numbers. And yeah, they haven't been as good as you probably hoped at the end of 21, early 22, but they've been fine. And if you kind of didn't look at the stock price, you'd be like, yeah, this business is performing kind of maybe, slightly below my base case, but it's fine. And you're just resulting on the stock price. And I think that's correct. But I also do wonder with them, like, how am I going to blow up? Because I've seen I used to cover gyms pretty closely. I've seen a lot of gyms blow up, and I always do worry, like, about that. So, any last thoughts on the blow up risk here, or not blow up, but how this doesn't work? What kills this investment?
Yeah. So you're right. What I was mentioning, it takes out some of the upside, but doesn't kill it. So leverage is low here, okay, below 2 times EBITDA. So I think it's not a risk of there's not a blow up risk here.
Are all the leases non-recourse? Do you know?
I believe yes. I believe they are. Yeah.
So because obviously a lot of the gyms do have hidden leverage, but with non-recourse leases, you can't have 7 gyms go bad and take a 300 gym chain under.
Yeah, it also gives comfort that spoken with people that former employees and people at PureGym, and everyone is quite positive on the story. So we also like to do that just because there can always be things that don't know us if you're not an insider, but there doesn't seem to be anything like that. But just on your point, so one, if things work out from a fundamental perspective, but the stock doesn't move, that's good because they can do buybacks with all the excess cash that they're going to have. And they have a shareholder base that's probably going to push them to do that, especially the largest holder, I hope. And two, it hasn't worked so far because they were trading at 10 times EBITDA pre-COVID. So the price you pay matters, especially if you're looking at the 5-year investment horizon. But that's not the case nowadays, right? So it's already, all the pessimism that could be in the stock, I think, is already there. That's what makes it interesting for us as well. We have this margin of safety on top of a business that we think is going to be able to grow at good ROICs. One thing that could kill it that I haven't mentioned is maybe we're wrong in terms of the resilience to a recession. Okay, and I think that's also a part of the bear thesis on some of these companies is that this is actually consumer discretionary. And if you go into a recession, people are going to cut their gym memberships, and you have this whole story of there's a lot of people that have the membership but don't go, so they're going to cut very fast their subscriptions, and with the rent, it all blows up. I think this is a bit of the worst way.
Tell me if I'm wrong, but I mean, one of the things I think Planet Fitness has seen, shown, proven out is that the low cost model is actually a lot more resilient than, the Equinox $250 a month model to recession, because it's so small. I mean, I've told this story before, but when we were diligencing Planet Fitness, we would talk to people and they were like, hey, I pay $10 a month. I never go to the gym, but they have Pizza Tuesdays and I just walk in every Tuesday and grab 2 slices of pizza and walk out. And I get free dinner three times a month, and that's worth it to me. And I'd be like, Jesus Christ, this is the best business I've ever heard of. But I do think the low cost gym's a little bit more recession resistant than the typical gym people might be thinking of. Do you agree, disagree? How do you think about that?
I agree. So we should go with transcripts from interviews to Planet Fitness franchisees that were operating back in 2008, 2010. They will tell you that as well. You can look at same-store sales growth for Planet during that time, although that's a bit potentially misleading because they were opening a lot of stores. Yeah, but it was also positive. Gym Group was actually founded in 2008, so worst possible time economy-wise. And you can actually piece together through their old reports the members per square meter during 2008 to 2014, and it was stable. So it doesn't seem like there was a lot of churn there. So yeah, we agree with that. We saw that again. We were invested in the largest low-cost chain in Portugal in 2015, and that was a very bad time for Portugal because of the European debt crisis, etc. And they grew quite well through that. So in general, I think that's also part of the thesis, right? It's the market thinks this is discretionary, and it isn't. I'm not saying I agree with that, but that's the one thing that kills it. But we think it's not going to kill it because it's not going to happen.
Quick mention: have you done a high rocks race?
No, I haven't. That's one of the
It's a big partnership, and look, it's not going to move the investment thesis one way or the other. But I almost did one last year. I was gearing up to do one this year, and probably not just because of the fact, but I saw it, and I follow High Rocks' Instagram, and I really like the race and competition and stuff. So I saw it and I was like, oh, I love it. I just love it when things you follow personally pop into investment thesis. Doesn't change it one way or another, but just have to ask. Cool. Any last thoughts before we wrap this up?
No, I think that's it. So we think there's a lot of upside both on the long term as well as the short term with potential CMD. If you look at consensus earnings, it's much easier to see upside for Gym than for Basic Fit as well. It's nothing that motivates us to like Gym. So we like the company. We think management is quite capable, and it's going to execute well in the next few years.
No, look, and what I just love about this thesis, aside from being a gym, and I just love thinking about gyms, I just love the thesis of, hey, you normalize the current store-based earnings, and this is fairly valued to cheap, but they've got this huge white space to invest in at really attractive returns that we've proven out across multiple markets, and you kind of get all of that upside for completely free. So I just absolutely love that combo.
Yeah, it's very cheap, right? If you normalize because it's like 3 times EBITDA so I wouldn't say it's fairly priced. It's fairly priced if they cannot get back to the 2019 levels. I agree with that.
Perfect. Cool. Well, hey, this has been great. Pedro, appreciate you coming on. We're going to have you on for a second time because I know there's 1 or 2 other names, one that we've done a podcast on, a few others that we haven't, that I'm looking through your letters that would be interesting. So appreciate you coming on, and we will chat soon.
Thanks, Andrew.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.